As we're waiting for the slides to come up, first of all, thank you very much, Ken, Burak, for the invitation. I'm thrilled to be here again. We really like the Berkshire, so if in the middle of the fall you think you see me walking around here, it's probably me. So feel free to say hi. I'm very lucky to have Shebnem had presented before me because I'm going to show you some things that she already talked about. And I'm very fortunate to have had Camelia present before me because I'm going to show you similar regressions. And what I'm going to spend most of my time here is, in fact, exploiting firms' collateral. So that's what we're going to try to talk about today. So I have 30 minutes. So I want to spend around 7 to 8 minutes talking about some motivation. I remember Ken asked me to talk about monetary policy, dollarization, and banks. So I'm gonna, let's say, start motivating why you should care about monetary policy. And I'm gonna talk about the transmissions first of US monetary policy shocks, because Ken here was the pioneer on identification of monetary policy shocks. Then I'm going to talk a little bit about banks. So 6, 7, 8 minutes about motivation about monetary policy shocks. 8 minutes about banks, and I'm lucky that Camilla already talked about that, so I'm going to breeze through that. And then I want to talk about the firm transmission and how different firms, first of all, I want to motivate how heterogeneous firms' banking relationships are across currencies, across types of collateral. And then I want to show you how these differences in firms actually matter for the transmission of these shocks. There we go. Thank you. Okay. So think that Jerome Powell wakes up in a bad mood, and orthogonal to everything that's happening in the US economy, he decides to raise interest rates. So what you see here is basically the response of the world economy to this, and specifically in emerging markets. So what you see in the top left panel is the dynamics of the interest rate in the US. So it goes up around 100 basis points. We see MB spread. So you can think that this is the surcharge that sovereigns in emerging markets have to pay for. So that surcharge goes up persistently around 80 basis points. The exchange rate depreciates dramatically. You can see also domestic rates. Right after Shebnem's talk yesterday, I added this to the panel. So you can see domestic rates also go up significantly. Inflation goes up a bit too, possibly because of exchange rate pass-through. And what you can see here is that bank credit falls significantly, falls around 4%. And I mean, not surprisingly, what you see is that GDP falls more than 1.5%. The fall in GDP in these emerging markets is even larger than the fall in GDP in the US. A large part, oops. All right. Oh, I got it. A lot of that fall in GDP is explained by a fall in investment. And you can also see in the last panel that both exports and imports fall dramatically. And this is joint work with Larry Cristiano and some co-authors in a chapter of the NBR macro annual that came last year, and a paper that's coming out this year too. So why are developing countries, let's say, fragile to these type of shocks? And I'm going to highlight 4 reasons. The first one is trade and financial linkages. So this is a detrended dollar index, or the strength of the US dollar. And you can see, well, private financial flow, specifically to the banking sector in emerging and developing countries, is very negatively correlated to the strength of the dollar. So when the dollar appreciates, you see that at least financing to these banks in emerging markets dries up. I think maybe even more relevant for a lot of the students here, commodity prices are very, very negatively correlated with the strength of the US dollar. So when I was having dinner with students yesterday, as I was asking them, what's the main thing your countries export? And for example, I was hearing natural gas, oil. And what you can see is that when the strength of the dollar increases, those prices are going to go down. And if you want to go into the market to finance, get new financing, well, if you're borrowing backed by commodities or your exports, that's also going to get tighter. Whoops. Why I think it's banking is particularly important, or as a source of fragility, is that what you can see is that you can see, because you have like this box here, but you can see that middle income and low income countries, basically they get all their financing from banks. So while the US, most of the financing comes from either the stock market or corporate bonds, in emerging markets, it's mostly banks. Another key source of like fragility is going to be financial dollarization. So for example, here you see, this is coming from a paper by Larry and co-authors. What you can see here is the share of deposit dollarization. And what you can see is that basically the median emerging market has around 20% of, let's say, deposit dollarization, but you have countries that have even 40 or 50%. And that has been highlighted by the literature. Roberto has a very influential paper about this, about the role of deposit and credit dollarization as a source of fragility. And lastly, I think this is particularly relevant, which is that in emerging markets, in developing countries, access to finance is being highlighted as a source of constraints for growth. And this is just from a World Bank Enterprise Survey. So they ask firms around the world, do you think that finance is a big source of constraint for your growth? And while in Europe it's relatively low, if you go to the Middle East or you go to sub-Saharan Africa, it's 2 to 3 times as large as let's say, at least as a perceived constraint from the point of view of the firms. So let me see, 6, 7 minutes. So what do we want to do? I mean, and this is like a potpourri of a lot of papers, is what we want to do is look under the hood. Let's say, take a look at what is key for the transmission through firms and banks. Let's say, who bears the brunt of this fall that we see in aggregate bank credit. And what we want to ask is, like, for example, do all banks respond equally? Do all firms cut credit the same way? And what is the role of FX exposure, leverage, and funding structures? So you have a little like graph there. Most of what I'm going to focus today is about US monetary policy shocks. Why? Because we have a very clear identification. It's a big issue in these countries. But in the last slide, I'm going to give you some message about domestic monetary policy. Okay, so let's start with some bank stylized facts. This is data for Uruguay. So I'm going to use a credit registry data set from Uruguay. We have around 20 years of data. The credit to GDP ratio in Uruguay is around 30% of GDP. 29.9 comes from banks. So there's basically 1 or 2 firms that can issue some type of corporate bond, but most of it comes from banks. And out of that credit, around 80% goes to firms. So for example, I remember when I was a grad student in the US with an F1 visa, I got a letter from a bank telling me you should apply to get a mortgage. And I was like, what? Mortgages don't exist in Argentina, where I'm from. And okay. And also, there's less than 10 meaningful banks in Uruguay. So this is very concentrated, very few banks that establish long-term relationships with these firms. Oh, sorry, can you click on the slide? There we go. So how do these banks differ? So we can go into a lot of detail, but as I showed you here, sorry, I didn't mention this, around a third of loans are made by banks of domestic capital. So what you see in orange and in yellow is these are capitals that are based, banks that are based in Uruguay, but are foreign capital or foreign subsidiaries. So for example, what you're gonna see is Citibank, that has headquarters in New York, has also a branch in Uruguay and lends to Uruguayan firms. So how do these firms, these banks, domestic capital, foreign capital, differ? So for example, I can ask them, okay, what is the financial assets that are domestically invested? So you see in blue, foreign capitals banks, in red, domestic capital banks. And for example, in the years 2003 to 2009, around 60% of their financial assets, this is on top of their credit to firms, was invested in basically financial assets from the domestic Uruguayan economy. This is basically sovereign bonds. After that, it has declined a little bit, but you can see that domestic banks have a larger role. What about liabilities with non-residents? So if you look at the liability side, again, blue is foreign capital banks, red is domestic capital banks. And what you can see is that around 35 to 40% of liabilities of foreign capital banks come from non-residents. You can think that this is wholesale funding. This is also a lot of Argentinians that deposit their money in Uruguay. We also caused a bank run a sudden stop crisis in 2002. So this could be let's say, sources of liabilities that are more, let's say, volatile than domestic liabilities. So they're going to be more susceptible to changes in foreign conditions. So what I'm going to show you here is basically the same graph. What happens when the US increases interest rates? What is going to be the impact in domestic currency loans and foreign currency? And what you see on the right is going to be, on the left is going to be domestic capital banks. On the right is going to be foreign capital banks. And what you can see is basically domestic capital banks are going to be less responsive to these type of shocks than foreign capital banks. So this is in line with what Shebnan was saying yesterday, that when there's changes in foreign conditions, well, banks that rely more on foreign liabilities or liabilities from non-residents are going to be more responsive to these shocks. And what we find is around like twice as large of a decrease in loans from foreign capital banks compared to domestic capital banks. Okay, so how am I doing? Do I have about 20 minutes? Okay. Am I going too fast? Here's where I'll spend most of my time discussing. So let's go to the firm's stylized facts. So here we're looking at a very rich credit registry data set in which we can see basically all the banking relationships of firms in Uruguay for the last 20 years. And let me highlight three things: credit dollarization, collateral quality, and debt to collateral dynamics. So the first thing is credit dollarization. So what you can see is that in the start of the sample around the year 2003, this was around 85%. So most of the credit was in dollars, in foreign currency. It has gone down. The central bank has pushed to do this, and right now is around 50%. So it's a decline of 30%. It's pretty big, but it's still significant. Then you can ask, are all firms borrowing in the same type of like credit dollarization ratios? And what you can see is that, well, no, there's a lot of firms that have basically no dollar debt, and there's some firms that have almost all of its loans in dollars. So what could be driving this? Is this driving, for example, by export status? And it's not just that. It explains a little bit. For example, non-exporting firms in green have a higher share of no credit dollarization. Exporting firms have a little bit more, but there's still a lot of variation in let's say, in their credit dollarization across firms. Another question is, okay, are loans in foreign currency and local currency substitutes? And what I'm showing you here is the decomposition of debt by terms of the loan. The first thing I should mention is that, for example, if you look at loan terms in the US, as like Ken was saying about deal scanner, that stuff, or that type of data sets, you will find that the average maturity of these loans are 3, 4, 5 years. If you go to Uruguay, around 75 or 80% of debt is less than a year. So these are very short-term loans. But how, let's say, how can we decompose them across currency? And what you can see here is, this is the total. This is foreign currency. And you can see that foreign currency is particularly used for longer-term credit. So I want you to think about these things not as, let's say, banks are choosing or firms are choosing. This is an equilibrium outcome. So you can think that banks are willing to lend to firms in dollars at the longer term. Why? Because it's probably less volatile, say less volatility on the value of these loans. So they're willing to lend at a longer rate. Also in these type of markets, dollar rates are much, much cheaper than peso rates. Why? Well, it could be, again, because there's a huge amount of deposit dollarization. People want to save in dollars. So what you can see is a lot of the dollar debt is more than 1 year. And if you look at local currency, most of the local currency is less than a year. So, okay. One thing to have in mind is if you're lending if you're lending in dollars at a long term, but you're financing that through deposits that are basically very, very short term, or you're financing it from the point of view of foreigners, that's going to be very susceptible to changes in financial conditions. Okay, let's talk about collateral quality. So what we can see in the data is, I was foaming at the mouth when they told me we could see this in the data, which is we can see almost all the details of collateral in the data set. For example, when I was, they basically told me in Uruguay, we have a lot of farms. We can even see the breed of the cows. So I was like, this is insane data. Okay, so coming from the data set, we can like order firms into micro firms is a less than 5 people. Small firms, I think, is less than 15 to 20 people. Medium firms up to 50, and large firms are larger than 50. And what you can see is that, again, micro firms, half of them pledge no collateral at all. And this shares, say, decreasing with firm size. And again, I don't want you to think about this as micro firms have no collateral in the sense that they can't present or pledge anything. I want you to think about this as an equilibrium outcome. This is, are there collateral? Do these firms have collateral that banks actually want? To give you an idea, is in Argentina, it's basically illegal to evict someone from their house. So if you can't evict someone from their house, why would a bank take their apartment as a pledge of collateral? They can't kick you out. They can never get it back. So they're not going to take it. So why were US banks willing to lend me money as a grad student for a mortgage? Well, because if I stop paying, they can kick me out really fast. The US has very low, let's say, liquidation costs. Advanced economies have very low liquidation costs. Emerging markets do not. Okay, let's see another type of, let's say, even if they have collateral, what type of collateral do they use? Oops, overdid it. This is collateral pledged by third parties. So this is not the firm has collateral pledged by itself. It's asking someone else to pledge it for them. And what you can see, again, this is decreasing in firm size. But one of the things you can see from here is that if you're a micro firm, you're an entrepreneur as a firm, what are you using as a collateral? You're probably using your own private savings accounts or your own, let's say, savings, let's say, investment or retirement pensions as collateral. So again, think about from the point of view of the bank, if it has to liquidate you, how hard is, or how, let's say, how much the legal system allows you to go after your physical assets. Okay, the other thing I wanted to highlight, or I want to, let's say, exploit in the data is thinking about like debt to collateral ratios, or a measure of leverage. And what you can see, again, there's a lot of heterogeneity. There's going to be firms that have very low debt to collateral, and there's going to be firms that have a little bit higher than that, even twice as much. Is this driven by firm size? Which you can see in red are micro to small firms, and in blue you have medium to large firms. So there's some differences, but there's a lot of variation across firms, even within these sizes. So I have around 10 minutes left. So let me give you a very graphical analysis to motivate the regression analysis. So when you think about decisions about how much to borrow, how much to invest, usually we think about it from the point of view of the marginal benefit of investing and the marginal cost. So usually we think that the marginal benefit of investing is a downward sloping curve because of decreasing marginal returns, for example. And we can think that the marginal cost curve is going to be upward sloping. Why is it upward sloping? Well, for example, you can think that the more you invest, the more you're borrowing, then there's a higher likelihood of default. Or the more you invest, the more capital, the more, let's say, collateral you have to pledge, and that makes it costlier if they have to liquidate you. So you have an idea of upward sloping marginal cost of capital, downward sloping marginal benefit of capital. Okay, so what I want to ask the data with this very rich credit registry is which firms are going to be more responsive to this identified monetary policy shock. So for example, you could have a very low risk firm and you raise the interest rate. What's going to happen with their marginal cost function? Well, the cost of capital is going to get higher. So they might want to decrease their, let's say, their optimal level of capital. What happens to more risky firms? What do I mean by riskiness? Well, I mean, if you're borrowing more in dollars, if you're borrowing more without collateral, or if you're borrowing more with relatively low quality collateral. Well, in this case, I'm being very, I'm foreshadowing here because I'm going to find that the more risky ones are going to be more responsive. But you can think that if the interest rate goes up and the marginal cost curve shifts, it could shift more to the left, it could shift less to the left. So in this case, it's shifting more to the left, and the decline in capital is going to be even larger than the low risk firms. So that's what I want to test. I mean, I'm foreshadowing my results, but I want to ask, in response to these shocks, which firms are going to be more responsive, the firms that have more or less risk? Okay, so I'm just showing you this regression because I was talking to Betuel yesterday, and you told me in the research department you were doing forecasting of inflation. So here's a regression for your entertainment. So what we're seeing here is the change in the loans of firm I from bank B in currency C at time T. As Camilla did, I'm going to introduce a lot of firm time fixed effects to try to capture demand shifts. I'm going to introduce bank time fixed effects to try to capture, again, the differential exposure of these banks. I've already showed you that. Now I want to just capture or exploit differential effects from the point of view of the firm side. And then I'm going to have this interaction, which is basically an interaction between some measure of riskiness of firms and the identified shock. And I'm also going to control for a lot of other variables. Also, why did I have this slide is because this is pioneered by Ken here. So if you have any questions about identification, you can ask Professor Kuttner. But what we're doing specifically, we're using Bauer and Swanson's AER's identified shocks. So what am I going to use, for example, as this proxy variable x tilde of riskiness of firms? We're going to use currency. We're going to use whether they don't have any collateral, and let's say their debt to assets ratio to try to exploit this differential impact. So for example, here's the estimate across time. So these are different time horizons, so from the moment of impact to 24 months later. And what you can see is that if you're borrowing in dollars, well, dollar debt is going to be more responsive to these type of shocks. So you can think that, well, firms are borrowing relatively, or let's say loans in dollars are going to fall more than local currency loans. I don't think this is super surprising. What about firms with no collateral? Well, if you are borrowing without any collateral, well, banks are going to curtail your credit even more than firms that do provide collateral. Again, think about whether these firms are actually able to present collateral at all. And the other interaction that I want to exploit is whether firms are relatively more in debt are more responsive to firms that are relatively less in debt. So what I'm finding here is that in response to this monetary policy shock, relatively more indebted firms that have a higher debt to collateral ratio are going to be more responsive. So what I'm going to argue here as a summary of the firm level results is that dollar credit falls relatively more. And again, think that these are credits that are usually used for long-term loans, usually more related to investment, to long-term investment. Loans with no collaterals fall relatively more, and relatively more indebted firms' loans are going to fall relatively more. And I argue that this is evidence of the transmission of these US monetary policy shocks is basically not through the cost of credit, but it's you're tightening firms' borrowing constraints. Oh, okay. I have, well, 7 minutes. I'm going super fast. Okay. So let me highlight one last thing, which is, as the type of collateral we can exploit in this data set, a question that shows up, and maybe Andres is going to talk about it later, is in which currency are collateral being priced? So we talked a lot about credit dollarization. We talk a lot about deposit dollarization. What about dollarization of prices? So Andres, you're talking about this later, right? Okay. So let me talk about the pricing in dollars of one specific type of good, which are assets. If you go to Argentina, if you go to Uruguay or other countries in Latin America, I hope that in a couple of hours when Andres talks about this, he's fact-checking me in the good way and matching what I'm saying now is real estate is priced in dollars. What other type of collateral do you think these firms might use? They might use farmland. Farmland in these countries is priced in dollars. Investment, capital goods, harvesters for agriculture, they're imported, they're priced in dollars. And what we can see is that here, what you have, this is a local polynomial. This is a fancy way of showing a correlation in which you have the share of debt in dollars by these firms, and you have the share of the collateral that's priced in dollars. So what you see is that when firms are borrowing relatively more in dollars, they're also pledging more and more collateral in foreign currency. So these firms, or at least these banks in these relationships, what they're, let's say, negotiating as an equilibrium outcome is you borrow more in dollars, you're pledging also more collateral in dollars. So you can think what they're doing here is trying to reduce the mismatch and the exposure to swings in exchange rates. So firms have dollar price collateral, maybe nothing bad can happen. Well, they had a huge financial crisis in 2003 when this was still happening, when they had a lot of assets priced in dollars. So you can think, why is this happening? And I want to again think about, okay, the backbone of borrowing backed by collateral is that you have a law system, a regulation system, in which if you're not paying your debts, you can be easily liquidated and the banks can receive back your assets. So what did they learn? How did the central banks react from these differences, thanks Ken, in collateral quality? Is what they did is they imposed monitoring of the banks into the firms. So for example, how does the Central Bank of Uruguay, the Central Bank of Argentina, let's say, assess the riskiness of these firms? Is they compare their cash flows to the debt repayments. So every month, what you see is that the category of firms' riskiness, that this is, let's say, assessed by the banks and shipped back into the central bank, is they compare their cash flows to how much they're paying in debt. And as a source of macroprudential policy, they have to do this every quarter. They look at their cash flows in, let's say, in whatever currency they are, and they say, under two scenarios, if you have a big depreciation of 25% or an even bigger one of 50%, how is that going to affect their capacity to repay your debt? Okay. So to finish up, I think like a couple of things that I want to highlight since I have 2 minutes left is these changes in external conditions that Shebman gave a great talk yesterday, they're going to curtail financing in emerging markets. And what I showed you today is these foreign banks or banks that have more foreign liabilities are going to be more, let's say, responsive to these types of shocks. And you can think that, okay, this means that foreign banks are bad. No, foreign banks are providing capital from the rest of the world into these domestic economies to finance, to provide more capital to lend and do more productive investment. But you have to be careful, this capital is going to be more fickle to changes in external conditions. At the same time, what I'm trying to show you is that firms in these countries with different, let's say, regulations or different laws, it's going to be more difficult for them to present capital or collateral that is easily acceptable by these banks. And what they try to do is, if you don't have any good type of, let's say, collateral or good quality collateral, well, they're going to curtail your loans even more. So how do these banks react to these high costs of liquidation? Well, they ended up having more monetary role and more macroprudential policy. And as Camila was saying, why do these emerging markets have so detailed credit registries? Well, because they provide a public good. If you go to Argentina and you want to borrow from a bank, in 2 seconds, if you get them the tax ID, you can see all my structure of bank loans, and they can see which loans have which asset used as collateral and what is my standing. And if, for example, using this risk assessment, if you're borrowing from 2 banks and one bank changes your assessment to risky and the other bank doesn't, the central bank knocks on the door and says, why didn't you change it? Why does bank A say he's really risky and the other bank doesn't? And for example, in one of my co-authors in the Central Bank of Argentina, which again is a very special country, what they're doing is they're using, you can say AI, but they're using large like neural network models to try to, let's say, assess risk, assess this risk of default on credit by using large network models and do some nowcasting of this risk assessment. All right, thank you.
Right, thanks for that terrific presentation, Santiago, and thanks for the shout out too. The check is in the mail. Questions from the floor. Again, giving priority to the CD. One, I'm. You have to wait. You have to.
I mean, he said moral hazard yesterday, and I was like, yes, that's which we should talk about. Like,
Thank you. Good morning. And I have a question, and you have mentioned that financial dollarization is a source of fragility and in low income and emerging countries. And I'm coming from Somalia, and we are dollarized country. So what would you recommend countries like mine and who lack and strong financial institutions and also lack of monetary credibility? And my second question is how can such countries transition towards de-dollarization and without triggering and further economic instability?
Mm.
Thank you.
That's a very tough question to answer. If I had that answer, I think I would be at the IMF or the Central Bank of Argentina if I knew how to solve all those issues. Huh? Yeah, right? I mean, I think those are very important questions and they're hard to solve questions. So if you look at the success stories of countries that have successfully de-dollarized their economies, it takes a really long time. So you have to have clear rules, clear policy rules in, let's say, in place for a really, really long time. And you have to have a government or policymakers that have very strong incentives to not deviate. So, for example, when Camilla was talking about banks and their liquidity, and she was saying treasury rates are very liquid and very safe assets, there was a part of my Argentinianness in the back of my neck, which was saying Argentinian governments tend to shove a lot of sovereign debt into these banks, especially when, let's say, sovereign risk goes up. So especially they shove all these like treasuries into these domestic banks when those bonds are really not worth anything. So you need to have a central bank and you need to have, like, say, a fiscal authority that ties their hands and tries to do good work. Don't have good institutions that do not have incentives to, say, print a little bit of money because elections are coming or try to do that. So if you have a strong currency, it will take some time, it will take a long time, but there are success stories there. So good institutions, no perverse incentives, and patience. If I knew.
Hi, good morning. My name is Estella from Zambia. I wanted to find out, I think both yours and Camilla's presentation, I was a bit unclear about this. In my country, most of the loans are linked to the policy rate a little bit.
Mhm.
So even if you've already borrowed, every time the policy rate is fluctuating,
Mm.
your rate of borrowing also fluctuates. Do you think that is good for stability or it worsens the situation? I don't know. Then I think Camila mentioned on the demand side, because I would think that if your cost of borrowing goes up, then it kind of places some demand for more credit if you want to refinance.
Mhm.
And on the NPL aspect as well. So I don't know how everything is interacting. Maybe you could like put me in
Yeah,
perspective.
I'm getting all the tough
Thanks.
questions. Thank you. I mean, my goal with this presentation was to like trigger your curiosity, and then we can talk the rest of the day. We can bail on the other discussants and presenters, and we can just no. But I think these are very interesting questions. And one thing to have in mind is most of these loans in Latin America, most of these loans are very short-term loans. So even if they're fixed rate loans, in 3 to 6 months they're going to mature, and the renewal is going to be attached to a new cost of borrowing. So if it's short-term rates, I don't think there's going to be a big. It's not going to matter that much. Um, what is usually more fixed rate are relatively longer term rates. So again, US, the most common type of mortgage is 30-year fixed interest rate mortgage. To me, that sounds atrocious. But again, like I come from Argentina, debt is like a bad word. I'm like very afraid of it. Um, but it gives you more, let's say, certainty. So why are firms in Uruguay borrowing in dollars? I mean, it's lower term rates because it's more stable than domestic banks and local currency. Local currency loans are usually very, very high interest rates. So they tend to borrow in dollars when they want to invest something very long term, and they have some good, let's say, project to invest to. So they're buying farm in one of the most fertile types of land in the world to produce soybeans that there's going to export to China because there's a very high demand. So if you could borrow in dollars long term at a fixed rate, that's great. I think everyone would like that. But part of the reason why they can do that in Uruguay is because they were one of the Latin American countries that had a relatively more stable framework for a reason. And for a while, they were considered the Switzerland of Latin America. Not for their stability and for maybe some tax avoidance issues, but yeah.
We'll get it Israel over here.
Thank you. I'm Israel from Rwanda. I have a question. Like you mentioned, the heterogeneity across firms, that especially on the credit realization. Does this picture you showed vary depending on the exchange rate regime, or?
Yes. I think it varies across countries. So you can see that there's going to be a lot of that across exchange rate regimes. So Argentina is a wonderful lab because we had different types of regimes across time. We had a currency board, so the 1 peso, $1 forever. That's what they said. Like when you see the announcement in 1991, they were saying like this is going to last decades. I mean, lasted like a decade and 4 months. So yeah, kind of there. And what you can see that when they had that regime, there was a big amount, a big share of credit dollarization. Then we had a sovereign banking exchange rate crisis altogether, and local banks had a lot of liabilities in dollars. They had a lot of exposure to the sovereign. And I think Argentina learned the hard way that a lot of bonds in the banking sector gives incentives to governments doing things that they shouldn't. So Shemnan's figure yesterday showed Argentina is right to the rightmost of the graph with almost no exposure of domestic bonds to sovereign debt. And one of the things they learned in Argentina is the only way you can borrow in dollars if you have a cash flow in dollars. So basically you have a limit on how much you can borrow. That is a fraction, I think it's 90% of the moving average of the last 3 years of your exports. So in countries that have had a lot of, let's say, volatility in the exchange rates, they don't have a floating exchange rate, but they tend to have devaluations or capital controls, capital control devaluations. Countries or banks at least tend to agree on we're only going to give dollar credits to firms that have cash flows in dollars, that they can actually have like a good repayment. And when you see what happened in the last couple of crises in Argentina, which was the last 5 years, or 7 years, I guess, you see that those firms that borrow in dollars show like almost no default. Why? Because the system is so regulated so that if you borrow in dollars, you are an exporter, you have a cash flow in dollars, you're going to repay your debt. Yeah, so you're going to see a lot of differences across regimes. And
Thank you. I have a question regarding your regression. I'm not sure whether I missed it. So did you also cover like how responsive or how immediate the government respond to the external shock into that regression? And if not, do you think that it is a good idea to also incorporate it into the regression? And do you think the result gonna change from what you show us?
yeah, so in the first graph that I showed, that's, is Shannon here? No, okay. So that comes from a paper I published with Larry Cristiano, and Shemnan was our discussant. So we talked a lot about this. And one of the things we kind of show is that emerging markets have starting to be able to, let's say, decrease their policy rate in response to these external shocks. So you could think, okay, they're trying to lower rates, to lower the cost of funding in response to these tightening of external conditions. And part of the results we're finding is that even when the central bank tries to do that, you still see financial conditions worsening and bank credit falling. I mean, a little bit of that is going to be Uruguay's commodity terms are going down because of the global recession, so they're going to sell less, so there's a little bit less demand. But there's also a shortening of supply. And one of the things I said I was going to mention, but I didn't, which was when we use the same identification strategy for Uruguayan's domestic monetary policy shock, we find the complete opposite results. We find that a tightening can be expansionary, maybe because of balance sheet effects, maybe because trade to GDP in Uruguay is around 70%. So if all your capital goods for investment come from abroad, if you appreciate your currency, you're going to make them cheaper. What happens to real wages in dollars? If you appreciate your currency with a hike, you're increasing real wages. So there's this at least partial evidence that contractionary monetary policy might be a little bit expansionary, but as Ken was saying yesterday, we have to be very careful about identification, and we have to be very careful about the DSG model we find to try to explain that. So it's very shaky results right now, so that's why I'm not showing you. But I think the takeaway is monetary policy shocks that are domestic compared to foreign monetary policy shocks, they're different animals. So you can't treat domestic rates and foreign rates as, let's say, substitutes. So they have different transmission channels, different aggregating impacts, different transmission channels. So you can't see US raising rates 1%, we are going to decrease ours by 1% and they're going to cancel out. That's not going to work.
Shockingly, I think we're right on time. Thank you very much, Santiago.
Thank you. Thank you for having us. Yeah, thanks.
We now have a 15-minute coffee break, so let's reconvene at 10:45.